Alright, so yeah, this is going to be recorded and everything, so you all can reference later. Let me share my screen real quick. Alright. This document is in the Project 100K group. It's also in the War 3 group. So you can download this as well. But a little bit of background on Elliot wave. It's a principle based on Ralph Nelson Elliot's conviction that social or crowd behavior tends to trend or reverse, and identifiable patterns are cycle. Now Elliot used his theory or this principle in the stock market, but it can be applied to the forex industry as well. So he used the stock market as his main source of research because it was way easy to chart the current and past behavior of a crowd with similar interests. He identified a number of patterns of movement or waves that reoccurred in combination with large and or smaller versions of the same patterns. Now what that means is there's movements or waves or a cycle within cycles. That's what I used to say or like to say. Those who are well versed in the intricacies of these patterns can gauge where the market's recent movements fit into them and then predict whether it will move to complete the cycle. Elliot's The Wave Principle was originally published back in 1938, and since then Robert Prechter has since become the foremost authority on Elliott wave theory. Alright. Here's the basic pattern. So it starts with X, is usually down here. 1 to 2 is the first new high to the new low. 3 to 4 is the second new high to the new low to wave 5. After wave 5, right here, to the 5th peak, there's usually a ABCD correction, which would do like a trend reversal or a trend continuation. There's a few guidelines when you're applying this Elliott wave principle as well. Under Elliott wave theory, the most basic pattern of market progress is the motive wave, which is subdivided into 5 waves and usually labeled by technicians with numbers. 3 of those waves, 1, 3, and 5, move in the direction of the underlying trend or impulse. That's the main trend that they're describing. While the 2 intervening waves, 2 and 4, act as counter-trend interruptions or retracements or pullbacks of the motive wave. At any time, the market may be identified as being somewhere in the basic 5-wave pattern at the largest degree of a trend. And that's according to the tutorial provided by Elliott Wave International to its members. Alright, because the 5-wave pattern is an overriding form of market progress, all others are subsumed by it. So this is one of the reasons why Christopher Terry uses Elliott wave in conjunction with Fibonacci in conjunction with harmonics. Those 3 put together tend to put off a nice sell or buy signal when they meet up. I've got this in bold because this is something that you really want to remember, embed it into your memory, because these are like, different guidelines and some rules to apply. And these 3 are basically the most cardinal or the most important. Wave 4 cannot enter the territory of wave 1. If it does, the market's latest move must be part of a larger motive wave, which could be progressing higher or lower. So let's go back up here. The first one says wave 4 cannot enter territory of wave 1. So what that means is, here's wave 1, right? Now on this wave over here, as you see, this low meets at the support of where this was a resistance, right? So the first rule means this wave 4, it can't close below this resistance where it's at, or support was at over here. That's a resistance over here. So let's say if it came down here and you started to see it pinning and things like that, yeah, it can pin, but it can't enter excuse me, wave 1. I've got a chart marked up actually that I did on the last training, and I'm gonna pull it up here in a second, and we'll go back over these rules. Wave 2, it can't retrace more than 100% of wave 1, and that's according to the MTA Association. If it does, wave 2 might not be a corrective wave as originally thought, and could actually be moving in the direction of a motive wave to a larger degree. Here's wave 2. So wave 2, it can't close below this lowest point right here. It can come down here, it can pin down here and all kinds of stuff. But if it retraces and you see candles, the bodies of candles begin to close below this lowest point right here, then this rule right here is no longer valid. Wave 3, which often represents the strongest part of the market cycle, can't be the shortest by price compared to wave 1 or wave 5, okay? So this wave right here, from 2 to 3, this is usually where the retail traders thrive at. It's a continuous, long, drawn-out trend, and it's a gradual trend. It's nothing that's fast or quick. Sometimes it can though, but this wave right here is the retailer's trend. Alright, so it's a long, drawn-out process most of the time. So as far as the movement of it, this price, the lowest to the high, has to be a bigger price exchange than, let's say, wave 1 and wave 5. So let's say use $1. So let's $0 to $1, right? This one has to move at least from 0 to $1.50. This one can move from 0 to $1.25. That's fine. As long as this wave 3 is the longest as far as price, it's a valid rule. This rule right here still stands, okay? Here's a complete cycle of the Elliott wave. You've got your motive wave and your impulses, followed by your ABC correction. And those are usually lettered. Your correction waves are lettered. Your motive are numbered, alright? A complete cycle of wave development actually consists of 8 waves, made up of 2 phases. You've got your motive waves divided into 5 waves, and then you've got your corrective wave divided into 3 pushes. The corrective wave, usually labeled by technicians by letters, consists of 2 with A and C that move in the opposite direction of the motive wave, and an intervening retracement wave B that moves in the same direction of the motive wave. Alright, so wave A and C move in the opposite direction of your motive wave, right? And then B moves in the same direction as your motive wave. And that's what they're telling you down here. This is a really good picture right here that demonstrates the cycles within the cycles. So before I get into explaining this, I'm going to try to basically label the cycles or the different trends that it's going to first, okay? Starting with the main trend is always what you want to try to identify first, the main trend. So you start from your lowest point, and this big one circle, this is giving you this whole push up right here. So this could be one push, or wave 1, 1 to 2 on this pullback, 2 to 3, wave 3, 3 to 4 on this pullback, and 4 to 5, right? Before you have an ABCD correction. Now, even on this first wave, right, you still got the Elliott cycle within happening on a smaller cycle. 1 to 2 on this first wave, 2 to 3, right? 3 to 4 on that pullback, 4 to 5, ABCD correction. So this is basically what you have to identify, is this larger trend. One push should have 3 pushes, or the Elliott wave going up to 5 in it. Sometimes it goes up to 7, 8, or 9, depending on what chart you're looking at, before you have a nice pullback in the trend, which is the ABC correction, before it continues up again. One of the keys of interpreting wave count is to determine what degree the wave in question represents. As the above chart shows, each wave could be part of a larger wave or of a higher degree, which in turn could be a part of another wave of an even higher degree. For example, the corrective wave A right here. Could be the beginning of a counter trend wave 4 pullback of a 5-wave uptrend to a larger degree. So here's your 5-wave uptrend to the larger degree. This pullback A right here, right? It's just part excuse me. It's just part of a counter trend wave 4 pullback. Alright? That's basically what all this is saying. In Elliot's original work, he identified 9 degrees of waves that could range from decades to intraday movements. And here's basically all his cycles. You've got the grand supercycle, cycle, primary, intermediate, minor, minuet, and subminuet. What we typically look at would just be the primary, the intermediate, and the cycle. 3, 4, and 5. This tells you the supercycle right here. This is part of a Fibonacci. I'm not going to go too in depth into this tonight. Alright. Here's some more guidelines for applying the Elliott wave. These guidelines basically are some more keys to using Elliott that you basically want to memorize, print them out, have them by your charts. That way you can, when you're marking up your charts with the Elliott, you understand, hey, if it sticks to these guidelines. But you got to understand, the guideline is not a hard or fast rule that can be broken. It's just a tendency or something that happens so often that it can almost qualify as a rule, except for sometimes it doesn't work as expected. And that sticks to any kind of strategy, any kind of whatever you want to use with Forex. Like, nothing, guys, is going to be 100%. Not Luciano, not Steve Morrow, not Christopher Terry. Like, nobody's 100%. And that's because the guidelines we use, like, even the indicators, they're not 100%. They're just guidelines that we can almost qualify as a rule. So just remember that. So these guidelines that we're going to go over, described below are useful ways of applying Elliott wave analysis. Okay. The first guideline is the guideline of equality. This one says that two of the submodal waves in a 5-wave sequence will tend toward equality, and is generally true of the non-extended waves. This goes back to market geometry, right? This is a good picture of Elliott wave, right? So you've got wave 1, and on this pullback it didn't retrace 100%. It retraced more than 50, it looks like, right? Which is perfectly fine, but not 100%, right? Wave 3 right here, by price, it looks to be bigger than waves push right here and this push. So that second rule or guideline we spoke about earlier still stands still, right? It's still valid. I mean, wave 4, it didn't even retrace wave 1, so that's still valid as well. Okay, so wave 5, what this guideline is here is that the two of the modal waves in a 5-wave sequence will tend toward equality. So we all know that wave 3 tends to be the biggest in price, right? Wave 1 and wave 5 typically have that same market geometry. So what you could do is, let's say if you recognize wave 1, take you a trend line and draw it. Okay? Just a trend line from the lowest to swing low to swing high. And let's say you see something like this happening and you can recognize that you're just on this wave right here. If you copy and paste this from right here to right here, that's going to give you a great take profit, a great estimate as to far as where to expect the market to go over here on this 5th wave, or this 5th push up. Alright? And that's what this first guideline is telling you. Guideline 2 is the guideline of alternation within an impulse. It says that the forms of wave 2 and 4 will alternate. Alright? If wave 2 is a sharp style of correction, wave 4 will be a sideways style of correction. So what the waves we're talking about is this wave right here and this wave right here. So let's say this is a sharp retrace, like this angle right here. This wave should be more flat, going sideways for like a flag or a pennant. Whereas this one could be like a descending wedge, or something like that. This one would be the pennant. We won't go over that on the charts as well. Here's the different picture for the guideline of alternation. As I said, this one trended down, whereas this one was more flat. The guideline of alternation within a correction says that the forms of wave A and wave B will alternate within in a three-wave correction. If wave A is a flat type of correction, wave B may be more of a zigzag type of correction, and vice versa. Alright, so even in, let me see if I can find it, your ABCD correction, right? Even within your ABC correction, you can have this one right here be a nice narrow steep retrace up, and let's say on your fifth one you can have a flat one, right, before it pops up again. That's basically what they're saying on the guideline of alternation, that it can happen in corrective waves as well, right? Guideline 4 is the guideline of depth of corrective waves. It says when the market goes into a correction, it often will correct to the territory of the previous wave 4 of lesser degree. This does not necessarily mean that it will reach the bottom of the previous fourth wave, but rather that we should expect it to reach the span of the previous fourth wave of lesser degree. This is often a good place for a market to find support or resistance before the trend moves on. So what they're saying is, on your corrective waves, point C should only at maximum hit to where this wave right here, this pullback, the low of this wave 4, before it pops up to either continue the trend or to meet resistance, make a double top, and fall. This is when you begin to read the price action of the candles. Also, you put up either your Fibonacci or your supply and demand, whatever works for you. Let's see. Channeling. This is nothing you all really want to have to worry about just yet. Well, actually, yeah, it is. This channeling has to do with a lot of market geometry. It's a technique to project the potential end of waves within impulses. That's what I was telling you all earlier. If you took the trend line and drew it from wave 1 from the low, swing high wave 1, and pasted it at the end of the fourth wave up here, take this, copy paste it, put it right here. It should be about equal length, right? That helps you project the end of the waves. This is basically what channeling is going to do. All right. Channeling is really a technique to project the potential end of waves within impulses. Although channeling can be used for corrective waves, it really boils down to the application of trend lines and doesn't have any hard tendencies for corrective applications. As for impulse waves, Elliot noticed that channel lines often mark their boundaries with sometimes dramatic precision. There are 3 ways that channeling can be used for projecting the end of waves, but they all use the same technique. They both require 3 points, beginning and end of waves, to create their one technique for projecting the end of wave 3, one for projecting the end of wave 4, and one for wave 5. Projecting the end of wave 3. Draw a trend line from the beginning of wave 1 to the end of wave 2. Project a parallel line off the end of wave 1. There is a potential for wave 3 to end when it reaches the projected trend line, right? So let's look at this real quick. That's basically like I was telling you guys. Draw your trend lines, copy paste them, and put them where they go. Even on your pullbacks. Let's say if you have this first pullback right here, copy paste this one. After you see this, paste it, and you should have a guesstimate or estimate as far as where this should end. It's all about, this is teaching you market geometry, basically, is what this is. I'm not going to go too in depth in all this, because that's basically just what it's saying. There are some different personalities to the waves as well. These are good to know to help you identify what wave you are in. Okay. Let's see if I want to go over this. Maybe political to trade in one direction, trade. Yeah, that's okay. Let me pull up this chart real quick. Any questions so far? Oh. Jeez, take a long time to load. Cool. Plus, it's got my work from. Nice. It's got my work from last class, actually. Dang. That's some good stuff right there. Alright, so last class, these red lines is the Elliot wave, what I drew. This was the main trend, right? And I was showing over here the cycle within the main cycle. That's pretty cool. Let me see. I'm gonna use this right here actually as the guidelines. I'm gonna show you the guidelines, right? So here's X to wave 1. Notice from wave 2 though, it went sideways, right? It just trended sideways, right? Here's that third wave. As far as price, it went fairly high. It went more than this wave and this wave. Okay, as far as price movement, right? So that, notice though, on this pullback, wave 4, steep it was. Remember the guidelines. Wave 2 should either be steep like this or sideways. Since this was sideways, wave 4 was steep, right? And then it pops back up. It tests your high, and actually this looks like an opportunity to short the market actually. Here would be your double top, guys. So you've got 1 push, 2 push, 3 pushes. Here's your 5th wave, so it should start to enter an ABC correction for you to all to short. Now on this ABC correction though, let's see if I could let's see. Let's see. So this could actually, come as far as this, right, on wave 4, the correction. I wish I could pull it all the way down, but so this ABC correction could come as low as this, but more times than not, on the correction, if it's going to be a trend continuation, it won't. Okay. So on this ABC correction, on this short here, you could short it. It'll meet this support over here, where A is. It'll bounce up, hit a resistance at the bottom of this, and should continue down. Now, as far as how deep this goes and how much this goes, it will vary. But this is I would actually do something like this. I could take this last push, Swing low, swing high to swing low. Take this line. Copy it. It's all about market geometry. Paste the trend line. And it gives me those targets or those areas where it should. So this would come down a little bit lower, and then reach the bottom of this, right? And then that would over here, this point and this point B would give you your double top or your M formation for you to really short heavily. All right. But that's pretty cool though. It had this drawn up. But as you all can see, it's a cycle within the cycle. These guidelines over here much tell you, hey, what to mark up, how to mark up, and if you just use those guidelines, you'll be able to identify a lot of market psychology or a lot of market sentiments based on trend and trader psychology. Let's see, y'all got any questions yet? No questions? What'd you say? Dang. So yeah. Yeah, I would say Euro's getting ready to show a bit for that correction, man. That's crazy. No questions, guys? What's going on? Y'all there? Hold on, let me pause this.